The average person in the United States in their late 20s has roughly $10,000 saved for retirement. With a portfolio size of $10,000, how much dividend income could you expect to receive? While $10,000 is not enough to properly fund a retirement, you might be surprised by how much it would pay in dividends. It might be enough to add a little extra to your income, pay for a vacation, or even help pay for a child's college tuition. Watch to the end of the video to learn some of the biggest mistakes investors make when investing in dividend stocks and how to avoid these so you can maximize your investments to make even more money in the future. There are many different investment options that provide different levels of dividend income. The amount of dividend income received from $10,000 invested in dividends depends on several factors, including the investment you choose, the dividend yield, and how long you hold the investment for. One of the most common investments is the S&P 500 index. The S&P 500 is a stock market index that represents the performance for some of the 500 largest companies in the United States. Since the index is so broad and contains so many different companies, you have exposure to many different sectors and industries. The S&P 500 has a long and stable history of returning high average annual returns. One of the greatest investors of all time and CEO of Berkshire Hathaway, Warren Buffett, has on many occasions said that dollar-cost averaging in the S&P 500 over a long period of time is one of the best ways for anyone to become wealthy. On average, dividend yield for the S&P 500 is around 1 to 2% annually. So, if you invested $10,000 in a stock with a 2% dividend yield, you could expect to receive approximately $200 in dividends each year. Even though the focus in this video is on dividends, it's important to keep in mind that the actual amount may be higher or lower based on the performance of the individual stocks and market conditions. The next on the list of common investments is the Dow Jones Industrial Average. The Dow Jones Industrial Average, also known as the Dow Jones or simply the Dow, is a stock market index that measures the performance of 30 large publicly traded companies in the United States. It was created in 1896 and is one of the oldest and most widely followed equity indices in the world. The Dow is widely used as a benchmark for the overall performance of the U.S. stock market, and changes in the index are often seen as a reflection of broader market trends and economic conditions. The Dow has an average dividend yield of 2 to 2.5% per year, which is not far from what the S&P 500's dividend yield is. The index has produced good and stable returns over many decades and would be another great way to place your money in for the dividends. Something that is not as common but definitely a good way of earning dividend income are high-dividend focused funds. A high-dividend fund is a type of investment fund that focuses on investing in stocks or other securities that offer higher-than-average dividends. These funds are designed to provide investors with a steady stream of income in the form of dividends, which are typically paid out on a regular basis, such as quarterly or annually. High-dividend funds may invest in a variety of industries and may be diversified across multiple countries, regions, or sectors. The specific holdings and composition of a high-dividend fund will depend on the investment objective and strategy of the fund. Some examples of high-dividend funds, or ETFs, are the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, with an annual dividend yield of 2.83%, or the Vanguard High Dividend Yield Index ETF, ticker symbol VYM, with an annual dividend yield of 2.69%. These are indices with a stable and long history of paying higher than average dividend yields. These are indices that usually only hold companies that pay out dividends. Some of these indices have a lower volatility than, for example, the S&P 500, but usually the average return is also lower. Even though volatility is not a good measure for risk, it can be a good indicator of what you can expect to get from these different investments. Another way of earning a higher-than-average dividend income is to invest in a sector fund or an industry-specific fund. A sector fund is a type of mutual fund or exchange-traded fund that invests in a specific sector or industry, rather than a diversified mix of stocks across multiple industries. For example, a sector fund could focus on technology, healthcare, financials, energy, or any other specific industry. These funds aim to provide exposure to the performance of a particular sector and can provide a way for investors to target investment opportunities in areas they believe have strong growth potential. Sector funds typically invest in stocks of companies operating within the selected sector, but may also invest in other securities such as bonds, real estate, or commodities. The specific holdings and composition of a sector fund will depend on the investment objective and strategy of the fund. It's important to keep in mind that investing in a sector fund can be riskier than investing in a diversified fund that holds a mix of stocks across multiple industries, as the performance of a sector fund is heavily influenced by the performance of the underlying sector. Sector funds can also be more volatile than diversified funds during market downturns or other economic events. Some sectors provide a higher than average dividend yield. The sectors that provide the best dividend yield can vary over time, depending on market conditions and the financial performance of individual companies. However, some sectors that have historically had higher than average dividend yields include utilities. Companies in this sector, such as electric and gas utilities, often have stable earnings and a regulated business model, which can lead to higher dividends. Consumer staples. Companies in this sector, such as food and household products manufacturers, typically have stable, steady earnings and can provide reliable dividends. Healthcare. Companies in this sector, such as pharmaceutical and medical device manufacturers, can provide steady dividends, although the yield can vary based on the specific company and its financial performance. Energy. Companies in this sector, such as oil and gas companies, can provide higher dividends, although the yield can be more volatile due to fluctuations in the price of oil and gas. You could also just invest in individual stocks that pay out dividends. There are thousands of companies that pay a dividend to its investors. A few examples are Johnson & Johnson, Coca-Cola, Walmart, Procter & Gamble, and ExxonMobil. These are just a few examples, and there are many other stocks that pay dividends. It's worth noting that the dividend yield and the amount of the dividend can vary over time and can be influenced by a variety of factors, including the financial performance of the company, market conditions, and company-specific events. It's also not recommended by financial advisors for beginners to invest in individual companies. So if you are new to investing, you should probably stick to the ETFs and indices. But if you do decide to buy individual companies, it might be a good idea to start with the ones with a long history of dividend growth to be on the safe side. The list of Dividend Aristocrats is a great place to start looking. Dividend Aristocrats are a group of stocks that have consistently increased their dividends every year for at least 25 consecutive years. Investing in Dividend Aristocrats can be a way for investors to target high-quality, financially stable companies with a track record of paying and growing their dividends. These companies are typically established, blue-chip firms with strong business models, consistent earnings, and a history of rewarding shareholders through dividends. The stocks mentioned earlier in this video are all examples of Dividend Aristocrats. The average dividend yield of the S&P 500 Dividend Aristocrats was around 2%. As we have seen, the usual annual dividend yield is somewhere between 1% to 4%. This means that if you have $10,000 to invest, your annual dividend income would be in the range of $100 to $400 per year. This might sound like a small amount for some, but as the years go on and if you reinvest the dividend income as well as putting in new money regularly, this can grow to be an exceptional amount. Even though investing in dividends sounds like a good idea, there are some common mistakes people make when investing in dividends that you should avoid. Mistake number 1: focusing only on yield. Dividend yield is an important factor to consider when evaluating a dividend-paying stock, but it's not the only factor. It's important to consider other factors such as the financial performance of the company, market conditions, and the potential risks and volatility associated with the investment. Number 2. Neglecting to diversify. Investing in a single stock, even if it pays a high dividend, can be risky. It's important to diversify your portfolio across multiple stocks and sectors to help manage risk. Number 3. Not considering the sustainability of the dividend. A company may have a high dividend yield, but if the dividend is not sustainable, it may be cut in the future. It's important to evaluate the financial stability of the company and the sustainability of its dividend before investing. Number 4. Overlooking other investment options. Dividend-paying stocks are just one investment option for income-seeking investors. Other options, such as bonds or real estate investment trusts, REITs, may also offer attractive yields and diversification benefits. Number 5. Not understanding the tax implications. Dividends are taxed differently than other forms of investment income, and it's important to understand the tax implications of dividend investing before making any investment decisions. These are just a few of the common mistakes people make when investing in dividends. It's important to educate yourself, seek professional advice, and conduct thorough research before making any investment decisions. Make sure to subscribe and watch the other videos on my channel for more finance and investing related content. See you soon.